Welcome back, everyone, to Vox Markets. My name is Paul Hurd. I'm delighted today to be able to host the next investing masterclass with three of the finest UK fund managers. So welcome, guys.
Hi, Paul. Good to be back.
Yeah, namely, we've got Judith Mackenzie of Downing. We've got Bond King James Athey of Abrdn Standard, and last but not least is Colin McLean of SVM Asset Management. Now, just to sort of kick off, James, I've got big apologies, actually, because 6 months ago, I gave you a really hard time when you suggested we were possibly going to have a recession around the corner in 2022, which I dissed totally. Now, giving you a spot on that there may well be have a recession, what's the sort of crystal ball saying currently in terms of sort of like all things economic and GDP related?
Well, I think it's just more of the same, Paul, to be honest. We're still on that same journey. It's been a rather long and violent journey from, pre-pandemic kind of late cycle into, what was unprecedented economic shutdown and stimulus. And since then, we've really been just drifting back towards more normal looking rates of growth. But economies tend to show inertia, and once they're moving in a given direction, they tend to continue in that direction until some external force acts on them. And these sort of external forces that we've become accustomed to, which is essentially policy of some sort, monetary or fiscal, those that not only are they constrained, but of course monetary policy is heading in the opposite direction. And so it looks to me that the consumer is going to be the last shoe to drop. We're seeing reasonable consumer data today, but it's again slowing consistently over the last few months, and I expect that to continue. So really my call, as much as it was, I fear we are headed to a recession, some economies quicker than others. But probably around the end of this year, you'll find the majors are all in recession.
What do you reckon, Judith? I mean, given we've got sort of an equity angle onto it, is it that bleak? Are we going to get a hard landing, a soft landing, or just a slowdown? What's sort of your view at the sort of small cap, the sharp end?
Well, I mean, I've been through cycles before. I think this one's going to be far different, sadly. I think it's going to be brutal. It's going to be exceptionally volatile. I think the markets are calling for about 13% earnings downgrades at the moment. I think it's going to be far harder than that. And we've seen a derating, but we've not seen the earnings coming through yet, really reflecting the current mayhem. So I've been pessimistic for about 6 years, to be honest. We've had 12 years of a bull market. And there was going to be something that happened, and we've now got this perfect storm. I think it's very difficult. In past recessions, you had probably more tools in the toolbox when it came to fiscal ability to jump in. I think now actually we've only got one, and that's interest rates. So it's going to be really tough. But from an equity and a micro cap point of view, any kind of disarray in markets provides opportunities. And I think for the careful investor, if you remain invested and you take a long-term view, then actually this could be quite an interesting hunting ground. But it's going to be brutal. That's what we get paid for.
What about yourself, Colin? Are you just sort of having that sort of like darker view of go forward, or do you have a more optimistic outlook?
Probably similar view to Judith, but of course, we're buying stocks and not the economy, and the timing for markets turning is not necessarily when a recession starts easing. So I think we've got to think quite differently about what's priced in already. I mean, there's been a slaughter in consumer stocks and many other areas already. So we have to work out what's priced in, and then what other surprises there might be. And I know we'll come on later on, I'm sure, to macro things and currencies, but a weaker sterling might be a boost for the UK market. There's a whole lot of things that might just suddenly, give us a fillip.
James, on those sort of potential sort of catalysts, what about obviously inflation, everybody thinks is going to last for longer. And I think you did sort of 6 months ago, but given it's now almost in double digits everywhere, I mean, just thinking about sort of potential catalysts. If there was a ceasefire in Ukraine and Russia, I mean, that would probably help. But is there anything? How do you see sort of inflation moving forward? I know you've got to make some leap of faith scenarios or assumptions, but how do you see that? And that if that does come down, then that will presumably alleviate some of the pressure.
Yeah, I mean, my starting point is that inflation is a poorly understood concept, and just in general, central banks, economists, investors, we've had a pretty terrible call on inflation over the last decade or more. And myself, I was calling it an inflation shock, and I think maybe that would have looked closer to accurate had it not been for the Russia and Ukraine situation. But this is now much more pernicious, much more self-reinforcing. And therefore a far greater concern. We can see that in the actions of central banks. The market's priced for inflation to be peaking roughly around now. The next few months expected to be as high, a little bit high, a little bit lower as it is currently, depending on where you look. But then the path down from there is reasonably rapid. In the US, going from 8.5 to 6.5 over the space of 3 or 4 months around the turn of the year. If that's correct, yes, that could allow the Fed to be less hawkish. I don't think that means pause. It certainly doesn't mean cut, but it allows them to be a bit less hawkish. But I don't think that necessarily shifts the needle too far. In terms of Russia and Ukraine, if there is going to be a ceasefire as it stands today, that's going to be from a position of Russian strength. And the international community is loath to let their foot off Putin's neck, lest that encourage him to engage in further aggressive actions in the region. So really, it's the sanctions which have been, as much as anything, part of the problem, certainly in terms of the energy market. And so it's not necessarily the case that a ceasefire immediately relieves some of the global commodity and supply chain stresses that we've been seeing. I'm sure markets will enjoy a ceasefire, will get a pop in risk. I'm not sure that's necessarily one that you want to be chasing. And realistically, again, levels matter as much as changes. Inflation is a rate of change in prices. If the level of prices doesn't decline, then you still have potentially this negative real income shock, because it would take presumably some time for wages to then close that gap and catch up to the higher level of prices. So a lot of moving parts, highly uncertain. If the market's right, things are going to look less stressful in 6 months or so, but there are risks in both directions to that view.
Right. And then Judith, just on the small cap side, I mean, I was looking at the sort of the indices, etc., and AIM in the UK is down 30% in the last 9 months. The FTSE is actually reasonably flat. The S&P is about 17, 18%. But given the small caps have led the downturn earlier in the cycle, what's your sort of view about whether they can recover faster than the sort of the wider sector and they offer opportunities? Because they seem to be a very leading indicator of sort of like equities and the economy. I mean, it happened I remember from the 2007, 2008 financial crisis, I think AIM bottomed in March 2008, and then the FTSE bottomed 12 months later.
Yeah, I mean, it's a funny index, as you know, in terms of constituent parts. And I suppose a lot of that fall that's happened already was a derating of some pretty heavily inflated prices, or in my view, in terms of valuations, some of the top end of the tech stuff. So, I think you have to be a stock picker in the AIM market. And I think when we're looking at a bit of a barometer as to how our companies are behaving and responding, we're certainly, and this is all a little bit anecdotal, but we're certainly seeing that some of the supply chain issues have come off the boil. They're not as bad as they were maybe 2 or 3 months ago. Freight rates are still quite high, but they're not getting higher. And actually just that loosening up of the supply chain market has meant that some of our companies are being able to be a little bit more nimble and actually hopefully not seeing margins depressing in the same way that we might have thought they would have done about 2 or 3 months ago. So I think there are some small chinks of light, but I think it could be short term. But small companies are notoriously better at being able to adapt quicker than larger companies, and that's really the benefit for these types of companies over the next probably 2 years, really.
And what about just on that small cap side, just on the demand side? I mean, supply chains easing up because obviously it's sector by sector, but you still see a lot of the small caps saying actually their demand, they can't meet demand. It's still pretty strong.
Yeah, again, from maybe a bit of a low base coming back out of COVID, but I'm still pessimistic. I mean, I'm trying to avoid mistakes as opposed to looking for earnings growth. So it's about trying to avoid and be sensible and not find the banana skins, as opposed to trying to buy growth. Now, saying that, we've always been a bit of a value investor, but we're actually being able to buy what were growth companies, and probably still will be growth companies, but maybe not with 20% compound growth over the next 3 years. But we might be able to buy those kind of companies at pretty much half the price they were on before. So that's a great opportunity as well.
What are you seeing, Colin, at the sort of the top end of the large cap side, and are you seeing sort of like the demand or supply chains improving at the bigger cap, or are you sort of sticking sort of like into certain areas that are offering better sort of like sort of short term outlook?
Well, it's certainly fortunate to further up the scale, mid and large, being able to buy some of the heavier weight pharma or a mining, oils, and so on. So there's a lot more choice, which you don't get further down the scale. I certainly hear the same things about supply chains. We do see them being fixed quite quickly. So I think companies are amazingly resilient and being able to adapt, and a lot of companies are adapting pretty well. I suppose further down the scale in small cap, we're still quite concerned about whether we're really getting price discovery. I agree with Judith, they're very quick to adapt and agile at the smaller end, but quite slow, I think, necessarily, to get price formation and maybe really have liquidity tested in the stock. So we would still see some risk further down the scale, and are focusing much more on the bigger mid caps and large cap, and still tend to be positioned around things that tend to offer value, I suppose, really. So even within growth stocks. Yeah.
And just you raise a really good point there, Colin. Just on that price discovery, the IPO market seems to have gone totally south this year. I mean, obviously came from elevated levels last, but it's about 70-80% down was the last stats, even at the sort of the large cap side. What are you seeing at that sort of like the fund manager top level area for sort of like being able to finance new listings or secondary issues with big cap stock? Is it still is it very tight at the moment?
I think institutional investors are still going to stand back from IPOs. Interesting that some of the IPOs that came along in the last couple of years, particularly in the growth and tech areas, have been savagely hit, and yet the same types of businesses still sitting in private equity portfolios don't seem to be marked down that much at all. So, I think we're still waiting to really see that reflected there. I think for quite a lot of companies, we're maybe not really seeing their cash flow tends to be, well, more particularly in the US, quite a lot of stock-based compensation. There's quite a lot of adjusted earnings. So I think some of the earnings are not as cash flow oriented as they might be, and we're going to find that out.
And James, now the other side of the coin when it comes to sort of funding is the debt side. What are you seeing on the sort of the corporate credit side, as in in terms of, I mean, when a company like Credit Suisse comes to you and says, I want to raise some new dollar debt, 1.5 billion, etc., and then we hear in the FT that it's been charged 9.75%. You must be licking your lips, aren't you? Or is it just really a no-go area for Credit Suisse? But just more broadly in terms of corporate credit, if the pricing is really difficult at the lower mid or in equity land, what's it like currently in the in the fixed income side?
Yeah, obviously, corporate bonds covers a multitude of sins, and certainly in terms of the financial sector, you just mentioning Credit Suisse there, you have a range of bonds up and down the capital structure, and some essentially sit closer to equity, and the sort of AT1 type names, they're the ones that tend to come with a coupon close to double digits. So as long as you understand exactly what it is that you're buying and where you are in the cap structure, you may well see there's value there. But just broadly as a comment on corporate fixed income here, you really couldn't wish for a worse scenario, could you? I mean, monetary tightening, high and persistent inflation across the piece, government bond yields rising rapidly with huge volatility, and the starting point being a huge amount of corporate debt out there. On a leverage basis, it doesn't look too bad because earnings and growth have been so strong in the last few years. But realistically, I care as much about the sustainability of the sort of denominator in that respect as I do the leverage calculation as it stands today. And I think you look at earnings trends and they're in the US 30% above trend, and you look at personal spending across a number of economies and it looks well above trend. And that's all because we've had a lot of artificial stimulus, not just in the pandemic era, but going all the way back to the post-crisis era. And it occurs to me that that was never sustainable, but the sustainability of that has never looked more in question than it does when we've got 8% inflation. So I don't think corporate bonds are the place to be. I don't think equities are a great place to be either. Just a quick comment on equities from me. Judith mentioned it in terms of earnings forecasts and where they are currently. In the US, you've got growth expectations declining quite rapidly. You've still got consensus talking about 15 to 18% earnings growth from this point. And it's on that basis that the market has derated as much as it has. If those earnings forecasts were to look more realistic and more in line with my macroeconomic outlook, well, then the market should come down, but that doesn't necessarily mean that valuations remain constant. They could even push higher for a period, and therefore you get a second derating. And history shows that that's when equity market declines become quite ugly, when you get this feed off between earnings expectations and the multiple that investors are prepared to pay for those equities. So it's not a good time to be in cyclical assets. And I think there are probably sectors in the equity market that I'd rather be exposed to, and regions, in fact. Some countries started off with much cheaper equity markets, and I'd rather be in high quality balance sheets in cheap sectors and geographies of the equity market than I think I would in most of the corporate credit world.
Okay, just on that multiple, Colin, what's your sort of view as a sort of sensible multiple for sort of like, for earnings sort of at the moment? I mean, I know the UK is on about 11 times, 11, 12 times it's come off, but and the S&P's now on about, I think I looked at it, 16 times compared to a long-term average of about 17 to 19 times. So that's sort of like, to come off, but it obviously depends on what you put as the year. And I think this year they're saying S&P was looking at it now 230 going to 251, so about 8%, 9% year on year for next year compared to this year, which may be a bit pie in the sky. But even if you use sort of 230, you're still looking at sort of like a relatively, depending on obviously what interest rate you use, the cost of capital. What's your sort of view as a sensible multiple that the equity should be, and how much downside you see from here?
I think there's quite a mix between different sectors. I think you can buy what still looks like growth with stocks like Glaxo and others and reasonable ratings. So quite a few of ours in the large cap area have got reasonable ratings, but we combine that with some ratings up to 20 times perhaps in distributors or others that we really think can pass on inflation. I mean, some of these businesses have got great long-term records, for decades. And I think the key is really passing on inflation, the price leverage that businesses have got.
Pricing power.
I think so. I mean, I remember I've been around long enough to remember the late 70s and some of the experience, that we had then, which looks not dissimilar. And initially, a lot of I would have thought value traps, heavy, capital intensive businesses looked like they were coping pretty well with inflation and with the downturn. But ultimately that destroyed their balance sheets. So I think balance sheets, the ability to have some pricing power, pass on inflation, long-term growth record, and I'd pay up even upper teens 20 times for that.
Oh, Judith, how much downside do you see in equities at current levels? Would you say? I mean, in terms of the broad sort of look of, are we looking at sort of another 10%, 15%, or even worse, maybe?
I'm going to leave this stuff to James in terms of the macro, but I think there's probably there's more downside than upside I'm seeing at the moment. That being said, we're buying maybe sort of 1, 2, 3, 4, 5% growth, and we're being pretty cynical on it, and we can buy that 5-6 times earnings. Free cash flow yields, that are double digit, and companies with balance sheets that are pretty strong. So, I think you just have to build a portfolio that you can hunker down with. It's not going to be pretty. It's, we're going to have a really difficult few years, and it's also quite difficult to see the catalyst as to what brings us out of it as well. My biggest fear is not that recession is going to happen. I think it is happening. We don't really know it yet, but it's more to do with how long it takes to get out the other end. And if you look at the peak to trough, going back to the dot-com days, that was about 31 months or so. And at the moment, we're probably about, I don't know, 6-7 months into it.
Right.
But we're not really into it yet, I don't think.
And just on the on sort of on the longevity and sort of the depth of it, etc. I mean, given you've got to be sort of like the market's likely to go down, but both yourself and Colin are sort of sort of picking some stock. Is it going to be more of an active stock pickers market rather than an indexing type of market, Judith?
Yeah, I think so. I mean, that's probably. I'm probably saying that because I'm biased anyway. That's what we do. But yeah, definitely, even within sectors, you can see such a disparity. And it's going to be quite a nice place for a contrarian investor at some point as well. It's just trying to figure out the time of it.
Okay, and then on fixed income land, James, I know you've sort of always had a very optimistic outlook, particularly over the last 6 months, but at least you must be sort of like, you were looking at yields on US treasuries at just over 1% when we spoke only sort of like, 6 months ago. And now they're at 3.2%. The 2-year yield is 2.2%. Even gilts have sort of like put 2%. They're nearly 2.4, 2.5% on 10-year. I mean, you must be sort of like, there must be something in there you're a bit more positive on, or is it really sort of like very short term and top level?
Can I just say how happy I am that Judith has joined us and I'm no longer the only dour, miserable bear on this call. It feels great to have some company, so thank you, Judith. Yeah, I mean, there is no alternative has been this god-awful phrase which has become just shorthand for, in my opinion, lazy and irresponsible investing over the last few years. Making non-like-for-like comparisons which really don't stand up to any fundamental scrutiny. I don't think you can really compare earnings yield with bond yields without thinking about the quality and sustainability of earnings and obviously the volatility of equities relative to bonds. And that's the sort of thing that people were quite happy to do. But some of those pretty bland valuation metrics bonds look either less uncompetitive or genuinely competitive. The dividend yield in the US is now below the 10-year yield. I still think it's going to be volatile and highly uncertain for the next few months. But when we sat down last time 6 months or so ago, I said really the way to play this was to expose yourself to a flatter yield curve. There are very different things going on at the ends of the yield curve. Monetary policy is pushing hard on the front end, pushing short-dated yields up, tightening policy, tightening conditions, trying to rein in inflation. In doing so, it depresses the medium-term growth outlook, but also it drags the whole curve up and it just makes those long-dated yields increasingly attractive to the sort of systematic buyers and owners of fixed income that we know are out there, the liability-driven investors, pension funds, insurance funds. And across our franchise, that's something that we have begun to see in the last few months. And so for me, we've obviously got a US yield curve somewhere around zero, but still, if I were to be investing into fixed income today, core fixed income that is, I would certainly want to be buying the longer end of the yield curve where I just think it's a little safer in the short term and there are still huge gains to be had when we get through this inflationary period, through the monetary tightening period and start thinking about dealing with the recession that I believe we will be in at that point. You should see long dated yields coming down at that point.
Oh, okay. And that's which currency? Are you talking about US dollar there?
US dollar would be my favored market, but honestly, the sell-off has been, I don't want to call it indiscriminate because there's been such commonality. It's a global inflation problem and central banks to varying degrees at various speeds and with varying amounts of hand wringing have all found themselves in the same place. Actually, the UK is probably where I'm most concerned just because the Bank of England is, in my opinion, being less forceful and less convincing in its attempts to deal with inflation. Lots of excuses being made, lots of nuance. Members of the MPC already talking about needing to pause rate hikes, even though they expect inflation to be 10 or 11%. With a small open economy, huge import penetration, a large contribution from the currency to the inflation basket, and permanently a current account deficit, that really does conjure up potential balance of payments crisis type forces. and I hate to make these comparisons because I'm structurally a bull on the UK economy, but that policy looks closer to Turkey's than it does to the US's. And so that's a bit of a concern to me. The market at the moment...
I'm not sure that's a pat on the back for the UK.
No, it's absolutely not. The market at the moment is ignoring the bank and pricing what it thinks needs to be done, not what the bank is telling us needs to be done. If the bank were to disappoint those expectations, I could envisage a situation where longer dated gilts become a very unattractive proposition. So yeah, the UK I'd be a little bit more cautious on, but ultimately there's value in a lot of fixed income. And I include emerging market local currency in there as well. I think they were earlier to start hiking, earlier to recognize the inflation problem, a more orthodox monetary response from most of those economies. Therefore, they're, I think, closer to the end than some of the Western central banks. And so higher quality markets like Mexico, like Poland, like Chile, to some degree South Africa, those are already looking quite attractive at the long end.
Well, just Colin, I know you touched on it last time, but what's your sort of view latest on the sterling sort of like dollar? I mean, because obviously that will drive some of your international investments, etc. Do you? Because I mean, I think it's 122 at the moment against the dollar. I think it was about just over 130 when we last spoke.
I can see it testing and going down through that kind of 115 level again. I think James made some good points there. Very easy to see foreign buyers and even gilt buyers here just go on a strike for a while or not see the need to be in the UK. So I can't really see what's going to support sterling from that, and particularly against the US that's got some actual growth. You know, the UK is in a better shape than Europe, perhaps, you know, in terms of not having these, you know, disinflationary forces and not having, you know, I think the euro has still got problems. It's a lot harder to control the periphery when you're you know, trying to tighten than it was before when you can buy in bonds. So I don't think the UK is, you know, the worst place to be, but I just can't see sterling, you know, sort of staying where it is just now. And I think we just have to factor that in, particularly against the dollar. I don't think there's much.
And is that one of the reasons why? I mean, obviously, one of the favoured areas last time was in sort of like, you know, commodities and oil and stuff. You know, the stocks where it's all priced, actually, the commodities priced in dollars, etc. And you seem to have retained those positions. What's your sort of thought process for that particular sector, for sort of like, you know, metals, mining, and the oil integrated oil gas guys?
I mean, there's still lots of ways of buying, even for a UK investor, admittedly, in the FTSE and larger cap, of buying the stocks, you know, the Ashteads, Ferguson, the Experians, all of these with good dollar earnings, and of course plenty in the commodities and other areas as well. So yeah, I guess we do have quite a bias in our portfolios to.
You're holding those, because I mean, they must have stabilised your portfolio, which is to a certain extent offset some of the difficulties elsewhere.
Yes, it certainly helped. I mean, what I do worry about in a global context is China slowing down and what that might do for commodities. So I don't think commodities are a slam dunk from where we are here at all. But certainly dollar earnings in various forms is something that we've got a lot of in the portfolios.
And now let's go through some of the specific stock ideas. We turned ladies first. Judith, as you are our newcomer into the team, what are you seeing in specific sort of opportunity areas? I know you're quite like fintechs guys in sort of international forex payments equals.
Yeah. Again, it's all very, very stock specific, isn't it? And you look at that one, and they're, as you know, it's a stock that you know well. Their growth rate, I think they've had about 2 or 3 upgrades in the last, it feels like about 7 or 8 months. And you're seeing that they're now doing about 280k a day. So you then translate that into the full year, and therefore you're looking at a 60 million, 65 million worth of turnover, and anything between sort of 10 and 12 million of EBITDA. And you know, you're buying that not at a crazy price. And you can actually see that there's probably going to be earnings upgrades coming through the year as well. It's got a very sort of operationally geared cost base, even though they're spending about 2 million a year on development. So it's difficult to see why you're not going to get an upgrade there. And therefore, you know, what should the price be in what I'm going to call a normal market? You know, it should be up at the 125, 130s. And what's it about, I don't know, 70 odd 80p now?
Yeah.
So, you can see, but, that's on the basis, and I think we'll be coming back to one of the earlier points, and that is that liquidity is an interesting area at the moment. What we're seeing when we're going into the market to pick up stock and see something like Equals, you go in and put your order in, and then before you know it, you get offered half the company. Well, maybe exaggerating a little bit, but we're certainly feeling that if you tap on the door, there's definitely quite a lot of stock about in various names. And I just feel that, you look, there haven't really been redemptions yet in the open-ended market in our space, in that small cap space. But being cynical, in every other recession, that's what you end up seeing. And that's not really tapped the market yet. So, I think we can end up buying good growth at the right price. Whether that gets reflected in share prices is going to be more challenging.
Yeah, I think what's happening is that if you do get distressed sellers, and let's be clear about it, we had plenty of distressors on the market last week, then they're forced to sell stuff they can sell, not what they want to sell. And if it's and that's why you get good quality companies if you've got a potential seller of that of a line. So James, just in terms of sort of like your areas, etc. I turn to you. Sort of like moved into a bit of cash there, I understand. But if it is cash in the short term, what currency and for how long would you hold that for?
Yeah, when you asked me that question, it felt a little bit facetious when I gave the number one investment idea for the 6 months ahead
sorry.
as being cash. No, it felt a bit facetious, but I think it's true. There's an aversion, like as an institutional investor, my client hasn't paid me to invest in cash, and of course you're restricted in how much cash you can earn, and we own and we understand the reasons for that. But for a lot of investors, cash plays a valuable role in the portfolio. Obviously, it reduces volatility. Obviously, it's something which is not going to decline in nominal value at a time where, looking around, every other asset class in nominal terms has performed horribly this year. And there are good reasons to think that some of that horrible performance is going to continue. So cash provides you some volatility dampening, but it buys you optionality, because when you have cash, you can buy other assets with that cash, and you can do so relatively quickly. You're not waiting to sell out of other assets to buy into whatever it is that's become more attractive. So I do think, both Judith and Colin have talked about the fact that there are going to be opportunities. We know from past bear markets, from past recessions, that all sorts of babies get thrown out with the bathwater, and you want to be able to take advantage of those opportunities. In 99, 2000, you could have bought Amazon for a song because it was a tech company, but it was a tech company like none of the sort of pets.coms that went the way of the dodo at that time. I want to have sufficient cash in my portfolio to be able to buy those high quality options when they become attractive. So cash is sorry, go on.
What percentage have you got in your portfolio of cash?
Well, as I say, we're in terms of the institutional portfolios, we're fairly limited. Normally it will be less than 5%, but we're definitely up towards the upper end of that range. But personally, I'm carrying a reasonable proportion in cash because I want to be able to deploy that fairly quickly if I see the need to do so, or if I see attractive opportunities to do so.
And which currency, given you don't like sterling?
Yeah, I mean, Colin's already talked about sterling, and I completely share his outlook there. Sterling's been one of our most profitable trades for the year. That's being short, obviously, and short mainly versus the US dollar. We've been dollar bulls for really 2 years now, and that was very counter consensus for a while, and it's pretty consensus now. But there is this concept in analyzing the dollar smile, and the idea is that the dollar serves two masters, really. At either end of the smile, the dollar does well. One is the world is falling apart and people want to buy the safest asset, flight to quality. US dollar, the world's reserve currency, is a winner. The other is the opposite end of the smile. Growth is strong, but it's so strong that the Fed is having to tighten. And the Fed policy is that much more significant globally than everyone else's, that it tends to be the case, if the Fed is tightening, that the US dollar becomes the currency of choice. At the moment, both ends of that smile are in play at the same time. That is a powerful dynamic. And of course, we've seen that play out in the US dollar's pretty consistent and precipitous rise certainly over year to date, and actually going back further. So it's come a long way. You have to be a bit cautious that these things don't last forever, and there's a lot in the price. We've reduced our dollar risk, but definitely our favored currency globally would be the dollar, and definitely one of our least favorite currencies, certainly in the developed world, would be sterling, with the euro, again, as Colin has said, not far behind that.
And just turning to some of your selections, Colin, I know you quite like the semis, don't you, with sort of Intel and Aixtron. And Aixtron I've never even heard of. It's out in Germany, isn't it, something? Some specialist in sort of like gases for manufacture of chips?
Yeah, yes, it's one that I would have to say, it's a checkered record, disappointed quite a lot of times. And we have Intel as well, and that's done that too also, although at least it's cheaper than its more successful rivals. I think quite an interesting, concept in a speech that Janet Yellen gave a couple of months ago was the friendshoring idea. And although I think a lot of supply chain problems are being sorted out, the possibility that China might be a problem at some stage is just going to ongoing encourage not just real scarce resources like rare earths, metals, and so on, but I think the raw material of Western growth, which will be semis and some of these other specialist areas. I think there'll be a strong move to favour national champions. Macron's talked about that, and obviously the US is talking about it. And I just think some of that stuff's going to get relocated from the east back a bit closer to home.
But why do you specifically like Intel, given it's had it seems to be getting annihilated by AMD and Nvidia and people like that. I mean, the technology seems to be pretty limited.
I think a lot of that's priced in. I mean, some of these things that
it's definitely cheap.
It's cheap now,
yeah. Okay. Then Judith, I know you quite like one of the Ashtead Technology, which again I've never even heard of, but it really seems to be an interesting play on all things offshore wind growth probably in the North Sea and overseas.
Yeah, I mean, we don't tend to kind of follow market trends too much, but we quite like this one. It IPO'd last year, and it's now had its maiden results out, and another business that will be doing about 55 million at the top line, growing at 30%. And we'll be doing about 12.8, I think, on EBITDA. So, and your market cap's around about 148 at the moment. So, and you're getting a really nice return on invested capital as well. So you're not at the moment having to pay too much to get that either. And clearly, it's in sectors that are or exposed to sectors that are definitely growing. So, it's a nice little business. I think it's underneath the radar as well because of its size. So you're going to get that growth, and I think actually you will get, I'm going to say, even dare to say, you might get a little bit of a re-rating in this one as well, because once people realise the sectors that they're exposed to, then they're probably going to pay a bit more attention to it, and you're buying on a PE of about 12 times at the moment.
Yeah, I saw the sector sort of like for predictions for offshore wind. I mean, it's set to grow. Well, I think it's somewhat tenfold over the next decade. So, obviously with green hydrogen and stuff like that. So really interesting, sort of like, I'd never heard of it, sort of like play, in that area. Now, James, just again on the, on sort of the portfolio, any other than obviously long duration US treasuries or cash, is there anything else? I mean, in the emerging markets you talked about you quite liked. I mean, there's sort of the smaller ones. What about, the ones which are actually, or the sovereigns which are easing, your Japan, your China. I think Russia's even easing now, if you really want to go a bit more sort of like high octane.
Yeah, I mean, Russia's one which you're going to struggle to invest in. Obviously, the sanctions mean that those bonds do not trade and cannot be settled anywhere globally. So
yes, exactly.
Unless you are a Russian national living in Russia, I'm afraid Russian bonds are off limits.
Yeah.
So we'll put that one aside. But yeah, Japan actually, I'm the other way. I think it's option-esque payout. Their policy now, they are literally the last man standing globally in terms of their policy setting. You mentioned China, that's a slightly different situation, but the BOJ reaffirming their rather dovish stance, signing their balance sheet up to unlimited and uncontrollable expansion, depending on the will of investors to sell JGBs to them. Meanwhile, headline inflation is 2.5%. Core and core are still below 2%, but they are rising, and the currency is weakening significantly. And Japan is a huge energy importer, which means the type of inflation we've had globally from commodities markets is even more dramatic in Japan via the weaker currency as well, because obviously they transact in dollars. That all feels like a situation which is not particularly sustainable. So being short JGBs and being long the Japanese yen feels like something which won't hurt too much if I'm wrong. And much as we've seen with other central bank promises which are broken, when the market finally wakes up to that reality, things can move dramatically. Thinking of the SNB floor in the Swiss franc from some years ago, or even the RBA in Australia, their attempt at yield curve control and the dramatic moves we saw there. So I don't feel comforted and wouldn't feel comforted by the Bank of Japan's dovish stance. I don't think JGBs are an attractive investment at all in this environment. I do like gold. I still think that precious metals have a role to play. I don't think that digital gold, or Bitcoin as some people know it, has turned out to be quite the defensive inflation hedge that some had thought. And while gold is off the highs, I still think there are plenty of routes to the gold price being supported going forward, not least it should be a defensive asset as we go through this very difficult, high inflation, potentially recessionary environment. If inflation persists, that should be good for gold. If inflation comes down sufficiently that central banks can cut interest rates, equally that tends to be good for gold because it's considered a low yield or negative yield asset and therefore becomes relatively more attractive when yields are low. That feels like one of those outcomes, if not both, are quite likely over the next 6 to 12 months.
And how do you hold your gold, James?
I mean, ideally, you hold it physically. If you're a real gold bug and you're sort of preparing for the end of the world, you wouldn't accept anything less than physical gold in your own storage. I'm quite comfortable. I'm not quite so, this may surprise you, Paul, given how miserable I tend to be, but I'm not quite so end of the world as some of the well-known gold bugs out there. So I'm quite happy to own an ETF which owns physical gold. But it is, for investors out there, it is important to ensure you understand what you're buying. There are some products, I think, which try and replicate gold with derivatives rather than having any physical storage themselves. And I think those types of products are probably to be avoided.
I think that's like the scenario, isn't it? You've got to know what you're holding with digital currencies, haven't you? Well, if there's 18,000 of them and Lunar and
nobody knows. Nobody
exactly
knows.
the terror.
That's just a leap of faith.
Yeah. Now, on sort of the mining and sort of the sort of gold and stuff, but moving now to Colin, with I know you quite like Glencore, don't you? Which came out with a very interesting trading update last week, saying it was making a phenomenal amount of money in its trading arm of coal.
Yes, I think you've got different parts of the business there, so it's quite an each way bet against different scenarios, arising. So, not expensive either.
8 times PE.
Yeah, so it's generating a lot of cash. I guess some investors may question some of its ethical credentials, which is something that needs investigating. But it otherwise seems to be quite well adapted to the sort of flexibility companies need now. And we talked a bit about flexible smaller companies. It's one of the most adaptable and flexible large ones. And I think one of the areas or other will play out quite well to what the economy throws at us.
And I saw actually, I don't know if you want to quickly talk about it, but I saw the news wires this morning saying Germany is now turning on its coal-fired power stations to be able to generate, so that you can store gas over the winter, which it gets limited amount from Russia. I mean, presumably, given I think it's the world's biggest trader and miner of all things coal, albeit dirty, it's got to be a boost, doesn't it? You'd have thought.
I think the climate emergency is on pause just now for various other existential threats. So, and it maybe always, was. I mean, we had that new EU taxonomy just before the end of last year, in which nuclear was good, said France, and gas was good, said Germany. But coal's in the equation. It wouldn't surprise me to see, certainly in Germany, some rationing on fuel, over this winter. So I think we could still be in quite a tough environment on energy.
And is that just on those commodities and energy? I mean, is there any chance you're going to get sort of like the government's deciding to put these more taxes on these guys because of sort of like short-term profits, or is it if they do so, people are going to turn off the investment?
I think the risk for investors just now is, maybe $200 oil is almost consensus now, and things don't go in a straight line. We're starting to see some more drilling now in the US, so quite possible we could just see some check to that, and I think it would take a lot of bets off the table quickly. So I wouldn't bet all on oil, but we're going to see some tightening of supply. I think really Germany and Europe fine just now, but if that war continues into the winter, it's certainly going to be a problem.
And then Judith, is there any other areas, any other companies you've got? I know you could quite like TheWorks and Tracsis and FireAngel.
Yeah, I mean, TheWorks is quite a brave one for us. It's retail, clearly. It's a family-friendly value retailer. I mean, you can go in and buy, a kid's toy for $1.99, that kind of thing. So it really is at the bottom end of the market. It's toys and games and crafts. So they came to market 2-3 years ago and made a right cod of it, really. Sold by private equity, which is always a bit of a warning sign. And they'd started really going on a store rollout plan, but now have got a new chair, new chief exec, and really just sort of retrenched a little bit. And what I quite like about these types of companies is that we're looking for situations where they've got levers to pull internally that are not market dependent or stock market dependent, or really they can almost buck the trend to a certain extent when it comes to the consumer. So we're not looking at further store rollouts. We're looking at further efficiencies on both online and the rent reviews that they're going through at the moment, where they can really actually get quite a decent benefit from what's going on in the high street. So they've committed to a 15 million EBITDA, and this is a market cap. I think it's on a PE of about 5.5 times at the moment.
Yeah, it is.
And actually, it could be a beneficiary of, dare I say, a much tougher market as well. So we're certainly taking a play on a management team that have been proved before in another business called the Card Factory, but not in this business just yet. And it has been tough for this turnaround situation. But I think for us, a little bit of a kind of contrarian play.
It's got £16 million of cash on the balance sheet, and you should say it should, in theory, be a net beneficial of the cost of living crisis if people sort of down trade, shouldn't it? Exactly. And just on Tracsis, which is, I think, is a sort of software firm for sort of data analytics for all things sort of rail and transport related. I mean, given the difficulties in network rail, I mean, it seems to be for efficiency. I mean, there's so much efficiency which needs to be done. It seems to going to be a long-term winner. It's just a matter of when.
Yeah, I mean, it's not the cheapest. It's probably one of the most expensive things in our portfolio at the moment. It's on about 20 odd times EBITDA, I think. But it's really good quality earnings. So they're selling into the train operating companies for the life cycle of a franchise. So you've got visibility in 7, 8, sometimes 10-year revenues. So they're also right up there when it comes to smart ticketing. And as you say, the networks are going to have to become more efficient. And really, you can only do that by going down the software route. So a little company based in Leeds that came out of Leeds University about 10 years ago, grown its earnings by about 10 times over that period, I reckon is going to get taken out at some stage. But at the same time, you've got a nice return on invested capital of over 20%, got net cash in the balance sheet, and you're probably going to get a nice journey, pardon the pun, when it gets to that take-out value, which I can see. I think consensus is around about £14, £15. I could see it easily getting there. Well, when I say getting there, I could see a valuation on it in terms of a trade exit around those levels. Yeah,
and that's one you can just sit there and leave it, can't you? And wait for those things to happen. Now, James, I've got a difficult one for you here, actually.
The others have been easy, Paul.
No, exactly. Given your sort of like, more pessimistic outlook, etc. What would be the key signals or catalysts that you would, if you started to see were happening, would prove you wrong, actually, and we're actually going to get more optimistic? So what I'm trying to do is to sort of say, if you're not right and you were dead on it last 6 months ago, okay, so we take this with a bit of a pinch of salt. But what might be the things which would then sort of like change your view?
I mean, a necessary but not sufficient condition has to be some sort of end in sight to this monetary cycle. At the moment, inflation upside surprises are increasingly being met almost tick for tick, blow for blow by increased hawkishness from the central banks. And again, while central banks are raising interest rates, it's very difficult to generate accelerating growth, particularly from where we started. So first and foremost, I think we need to see inflation topping out. If that happens soon enough that economic activity remains reasonably well elevated, then that's going to be the first potential signpost that it's not going to be as bad as I feared.
And what would do that? What would reduce inflation quicker than you think?
Well, that's a great question. It's complicated. Obviously, a lot of the inflation is sort of globally generated. It's not sort of domestic in nature, and it's really outside of the control of any policymaker or set of policymakers. So some stability in commodity prices will certainly help. And then, again, as Judith and Colin have already mentioned on a few occasions, it's going to be relief in some of these global supply chain problems. And you mentioned yourself the Ukraine and Russia situation. Potentially you could see some relief there. But again, a mathematical, a kind of boring, geeky point to make. Inflation is measuring changes. And so you don't need levels to decline for inflation to tend to zero. If the price was $1 million yesterday and it's $1 million tomorrow, that's an inflation rate of 0, even if $1 million is a huge looking price for anything. So automatically, without an ongoing sort of push behind it, inflation should mean revert. So I think some combination of those things is likely what we're going to see.
I think the labour market's also sort of like in the tech area, a softening a touch. Certainly, they've got large, big techs who are hiring freezing and
the labour market. That's a really tough one because it's the most important economic cyclical indicator, if you like, but it's also the most lagging. So it's not much use at looking forward. It's very, very instructive in terms of where we've been and where we are in the cycle. And we started with this incredibly hot looking labour market where pretty much across the Western world, the number of vacancies and the number of people available for work had never been so mismatched. So you could lose a lot of labour market strength without unemployment ticking up. But that's trying to fine tune that, which is what central banks think they can do, is nigh on impossible. And I fear that central banks are always reactive, really, rather than proactive. And I think they will keep pushing. And Judith already mentioned it. We may already be in that recession. That's a process which is probably going on now. And the statisticians will tell us in 12 months' time that it was indeed happening now. And therefore, central banks will still be pushing actually long after things have already broken, which is essentially my base case. But if I'm wrong on that, and if companies are more patient, allow margins to tighten significantly, that might be bad for the equity market. But conversely, that might keep unemployment low, and that might be a good economic signal.
Right. And then, Colin, I know you've got one contrarian play, JD Sports Fashion, which is actually trading again, and it's come off a long way. Market cap 5.5 billion, but PE is less than 9 times at the moment for sort of like a major brand.
Yeah, no, I think that would be our bet on things being priced in already. I mean, there are some question marks about getting a new chief executive and chair in. But it's got a lot of pricing, control. It's got a great market position, and came out with good results. And as you say, the rating's not high, so I think a lot of that's priced in already.
Okay, and then finally, just to finish off, then, Judith, I know you've got sort of you've got FireAngel again as a sort of like a contrarian play, and it's sort of like does smoke and fire alarms and stuff. But I think when you chatted about it last time, the idea was to improve its gross margins and go further up the value chain.
Yeah, and it's done that. So, as Colin will know, in Scotland, we've all got to have interconnected smoke alarms on every floor of your house, which means that the average spend in the Scottish market is about 220 quid to upgrade your fire alarms. Now, that's just one part of the jigsaw, really, because clearly after post-Grenfell and the regulations that are coming in, housing authorities are are spending about 100k a month trying to get night watchmen in buildings, and even availability of those night watchmen is not great at the moment. So there's a problem there that needs to be fixed, and quite frankly, there's only about 2 companies in the world that can do it. One is an Irish-based company, and the other one is this little company, FireAngel, 20 million market cap. It's had it's been around the block a little bit. It can find a banana skin at every turn, but at the same time, it's got a new chair. It's got a chair that's now been in place for the last 2 or 3 years. It's got that gross margin improvement plan that is now kicking through, and they've also got this big deal with a company called Techno, a German company, who are the leading provider of green and smart homes in Germany. So it's about 11p at the moment. Nobody cares about the share price at all, and I could see it north of 40p in a trade deal, which I think is probably inevitable in the next couple of years.
Brilliant. Okay, well, that's a great way to finish. So thanks very much, guys, for your excellent thoughts. And obviously, we've got a tough economic outlook, but obviously with also sort of like some smart areas that you can sort of like preserve capital and then look for longer term growth, then there's some good ideas for people. So thanks very much again, and look forward in touching base in about 6 months' time, and let's see how we get on.
Thanks, Paul. See you next time.
Yeah.
Bye.